Deputy Prime Minister, Governor Zeti, Chairman Krachong-Seng, it's a pleasure to be here to introduce to you the findings of the 6th OMFIF Global Public Investor Report, the first time we're launching this in Singapore. But just to start, who are global public investors? So this is a term that OMFIF has used to introduce the collection of institutions that manage public money, so public investment institutions. We look at 750 such institutions. This includes 173 central banks, 491 pension funds, and 86 sovereign funds that are located around the world. The majority of these institutions, around 2/3 of these institutions, are located in Europe and North America. These regions also hold around half of the total GPI assets. Collectively, the 750 institutions hold, as we heard just now, around 38 trillion of assets, that's equivalent to 43% of global GDP, so it's a very big component of the global economy. But the single region with the biggest concentration of assets is Asia Pacific. It hosts around 38% of these 38 trillion of assets, and it's home to the world's 3 biggest GPIs. So the People's Bank of China is at number 1, the biggest reserve holder. The Japan's pension fund, Government Pension Investment Fund, is at number 2, and the Bank of Japan, where of course reserves are managed by the Ministry of Finance, that we do include it in this list, is number 3. So Asia really holding some of the world's biggest GPIs and the biggest concentration of assets. Singapore also has some very big funds that are included in the top 35. So for example, GIC, Temasek, the Monetary Authority of Singapore, the Central Provident Fund are all very big GPIs with assets over 200 billion that are included in this list. The Middle East also home to a lot of GPIs, especially sovereign funds. So as you can see in this map, and it's also in your book, even though there's only 14 sovereign funds, around half of those that are in Asia, the level of assets that are held by sovereign funds in the Middle East is very similar to those of Asia, even though there are more funds in Asia in the sovereign fund category. Africa and Latin America, we also look at these, but less important regions for GPIs. So we've been doing this for 6 years now. Here you can see the evolution of GPI assets. As you can see in this chart, GPI assets are now at their highest level ever since we've been looking at these numbers, and it's the second year in a row where we've seen all 3 types of institutions increasing their assets. In the case of 2018, this is what the 2019 report refers to, is data for 2018. We've seen growth of around 3.7%. This was slower growth than what we saw last year. Last year, GPI assets grew by 7.6%. It was a record growth last year, but it's still very important that we saw this growth in a very challenging environment where markets have not been doing very well. And assets increased along all 3 institution types. So in the case of central banks, that was very small change, around 0.1%, so broadly steady. Sovereign funds, so big growth of around 8%, and pension funds of around 5%. In absolute terms, pension funds saw the biggest increase of around 700 billion, as you can see in this chart. But the overall figures also mask important regional differences. So not all funds across all regions saw assets increase. Europe was the only region where asset across all 3 institution types increased. North America and the Middle East saw big increases. The Middle East was the biggest increase in terms of percentage rise, and that was partly reversing losses that we saw last year. Last year we saw a lot of central banks, especially in the Middle East, see their reserves decrease, challenged by decreasing oil prices. Now we saw a reversal of that this year that boosted especially sovereign funds and central banks in the Middle East. North American pension funds also saw strong growth, but still it's not enough. You have a very high level of unfunded pension fund liabilities in the US, that even with this important growth that we saw this year of over 500 billion in North American pension funds will not be enough to cover this. Latin American sovereign funds saw a very big decline, around 17% of assets in sovereign funds in Latin America declined, challenged again by fiscal environment, some governments drawing on the sovereign funds that are serving as stabilization funds in that region to support their budgets. And while there's idiosyncratic factors for each GPI in our list for each region. There are some broad trends that we can talk about, and I'll walk you through these now. So one broad trend is the negative performance of equity markets around the world. Equity markets seeing one of their worst years since the financial crisis, a lot of declines in some of the key indices that you can see here up to December 2018. So it's something that challenged central bank portfolios, especially because, as we heard from David this morning, public investors have been growing their allocation to riskier assets in the face of a low-yielding environment of the past decade, supported by quantitative easing policies by central banks and extremely low yields on bonds. So we estimate here that around 10% of central bank assets are now in equities. This is based on analysis that we've done of a survey of global public investors as well as their annual reports. This covers around 18 trillion of assets, so it's fairly representative. Around 40% of GPI portfolios are covered in this analysis. So you see, according to our estimate, it's around over 1 trillion of assets of central banks are held in equities. And this has been motivated by this low yield environment. Sovereign funds, of course, much more able to invest in these riskier asset classes, real assets, equities, same for pension funds. Central banks are more constrained, and this is something that we've also explored in our survey this year in terms of what are the processes through which these GPIs can move into new asset classes and increase their allocation to riskier assets. And we also asked in the survey, how have central banks particularly responded to the low yield environment? And over 40% of central banks and just under 40% of all GPIs said that they have increased their risk budget in order to cope with this low yield environment. And just over 30% of central banks said that they have accepted lower returns. So you see mixed approaches there. And we've had various quotes from central banks that you can see in the report as well. Some saying that we are concerned about the negative equity environment. We are concerned that we're close to the end of the business cycle and we want to exit some of these investments. But overall, when we ask them about their forward-looking plans, they said that they plan to increase their investments in equities. And you can see here, especially some of the biggest funds, so this is the top 10 GPI funds, Government Pension Investment Fund in Japan, the Swiss National Bank, GPIs that have a relatively high and well-known allocation to equities, suffering a loss in their overall level of assets because of the negative equity markets. But still looking ahead, just around a quarter of GPIs plan to expand their investments in equities next year. So this is over the next 12 to 24 months. And that the equivalent figure for central banks was 26%. So central banks, through their policies, are depressing yields in traditional assets, and through the reserves management policies have to respond to that, respond to their own, to the effect of their own actions and move into equities themselves. And a lot of GPIs are also planning to reduce their investments in government bonds and cash. Real assets, infrastructure, and real estate are also remaining popular. I'll talk about this in a second. They are assets that have done fairly well. So the equity market was one of the drivers of the trend in GPIs, but it was offset partly by the continued global economic recovery. The recovery is slowing, but we've still seen growth across both emerging and advanced economies, and this has boosted the value of several asset types that GPIs hold in their portfolio. So real assets, I spoke about it just now, are over 90% of GPIs have said that their real asset investments have done better than their other types of investments, and there's various motivations for why they're investing in these asset classes, such as higher yield, diversification, good income, low volatility, and so on. These were some of the reasons that GPIs gave us when we asked them, why are you interested in investing and expanding your investments in real assets? However, some are more constrained in terms of their ability to invest in these asset classes, especially central banks have relatively high restrictions in terms of the illiquid asset classes that they can move into, and around 60% of the respondents to our survey said that they are not allowed to invest in real assets at all, and that it's very difficult for them to get board approval to do so, to understand the asset class, to find the right external managers to partner with to understand this asset class. And even if they were allowed to invest, 36% said that they are skeptical and that they would still not invest. The other driver of GPI asset valuations is, of course, exchange rates. A lot of foreign reserves of central banks are held in US dollar, and also sovereign funds and pension funds. So the strong dollar supported these foreign reserves of several GPIs. It was also a driver of something else that we look in the report, and there's a special report in the publication that you have of the research we do every year on the net international investment position. So this is the difference between the world's biggest creditors and biggest debtors, and the gap between the two has grown to its highest level on record, 33 trillion, 33.8 trillion of gap between net creditors and net debtors. David spoke earlier about Germany now becoming the world's second biggest creditor, surpassing China. We saw big movements in the world's biggest debtors as well. The US, the UK, and Mexico increased their net liabilities and are now even more bigger debtors than they used to be. China, on the other hand, is reducing its position as a world's net creditor. And this is also fueling these tensions that we've been seeing, the trade wars, the investment wars, now seeing Donald Trump's tweets yesterday, the currency wars as well, translating into the skepticism over China and its policies. And we've seen that being translated into the area of investment as well, even though trade has attracted all of the headlines. Countries across the West are also taking action to limit investment from China, particularly in high security areas and technology areas. So you see here the US, Australia, UK being some of the biggest recipients of Chinese foreign direct investment, but also countries in Europe increasingly taking measures that are the so-called investment screening measures. The US has had these in place for a long time. The Committee on Foreign Investment was strengthened over the past year to have a bigger mandate in terms of what kind of investment we can screen out of China and other countries, but also in the EU we have around half of EU states now have these screening mechanisms in place, and there are plans to add also pan-EU guidelines on foreign investment screening. On the other hand, you have some countries that are taking a very different approach to Chinese investment. So countries along the Belt and Road, for example, that are getting increasingly cautious about the economic policy uncertainty coming from the US and want to get closer to China. We are seeing them building up their gold purchases. They cannot move away from the US dollar as a dominant asset in reserves and put it into renminbi. Renminbi is still something that is up and coming, but a lot of public investors are very cautious to put their reserves into that. They're instead putting it into gold, and we've seen central bank gold reserves rise very heavily this year to a 50-year high, almost half a century, and also very big increases by countries such as Russia, Kazakhstan, Turkey, countries that are increasingly moving away from the geopolitical influence of the US. We asked also about the role of the renminbi, even though quite a lot of respondents, a majority of respondents said that they will see their role increase and that they will have a greater involvement. It's something that is happening very slowly. Finally, I wanted to share a few of the trends of what are the future issues for central banks and for public investors. There is a lot of information about this in the report that my colleagues and I have worked on. This is just a flavor of what are the future risks that we saw. So external economic developments, external political developments dominating on the mind of sovereign funds, pension funds, and central banks. But some of the ones I'd like to highlight is communication, especially for central banks. So we've done a report looking at how central banks are communicating with the public, and Twitter and social media use was something that we looked at. So the first central bank on Twitter was the Bank of Canada, with an account in both French and English, so 2 accounts by the Bank of Canada. They also have 2 accounts on Bank of Canada Jobs. Since then, it's grown to around 120 central banks on Twitter. The Central Bank of Spain, of Jamaica, were some of the latest central banks to join. The Bank of Jamaica even has some reggae videos explaining inflation targeting regime, if you want to engage with that in a different way. But the world's most followed central bank is the Central Bank of Indonesia, the Central Bank of Mexico as well, and as one would expect, the Federal Reserve and the European Central Bank have a lot of international observers. In the case of Indonesia and Mexico, it's mostly tech-savvy local populations that are following these accounts. Mexico mostly tweets in Spanish. And you see some other central banks that also have very heavy Twitter following. So it's a new area for central banks. How do we communicate with the public? How do we make an impression that we're no longer these technocrats locked away in some ivory towers, but it's something that they are increasingly looking to do. A second challenge for central banks is climate risks. We heard a lot about this from Frank and from the Deputy Prime Minister. This becoming increasingly at the forefront of the mind of central banks. They've set up this network for greening the financial system. in December 2017 with 8 members, has now grown to 36. But even though there's been a lot of central banker speeches on the topic, over 20 speeches by central bankers between March 2018 and April 2019 were on climate change. This is a record number. It's something that they are increasingly spending their time and attention on, a lot of conferences on climate change. But when it comes to their policies as investors, they're very much behind sovereign funds and pension funds. So in our survey, virtually all sovereign funds and pension funds said that they have sustainable investments, whereas under half of central banks said so. And when we look ahead, again, this was a statistic quoted earlier, quite a lot of GPIs in general plan to expand their investments in green bonds. So it's great to see Singapore taking a lead on that and becoming a hub for this type of financing. Finally, another issue that we're seeing coming up on the radar of central banks is digitalization, blockchain. How can they adopt that in their own payment systems? And we see here several experiments. It's probably too small to read, but it's all in your report and in the book that you have about the central banks experimenting with blockchain technology in their interbank payment system. So Project Yubin in Singapore, also by the MAS, is something that is along those lines. So this is just a flavor. There's a lot more in the report. And we also have a data bank, an interactive data bank this year. There's some little cards that were out by the table where you can scan the QR code and go and play around and find each fund that you're interested in, hover over the bubbles here and see how each region has changed its assets over time. You can select specific funds and look how their assets have been changing from 2013 to now. So I'll let you play with that in your own time, but thank you for your attention so far. And I'll introduce the panel to the stage to talk to us about sustainability and the UN Sustainable Development Goals. Thank you.